Hey everyone, welcome to another episode of Mayhem in the Markets, coming to you Saturday, June 24th. So we're going to look at commercial real estate first because there are some issues in this area of the market. We're coming up on about $1.4 trillion worth of maturing debt, according to measures by Moody's. And this is something that's going to unfold from the back half of this year through the first half of 2024. So that delinquency rate that is rising, as we can see on the chart below, it is a concern. It's not the highest it's ever been. That was 10.34% in July of 2012, but it is on the rise, as is the amount of delinquencies that we're seeing in retail and in some of this office space as well. So why is that important? And we can see that the office space is the red line on there, jumping up meaningfully. It's important because commercial real estate is an area where life insurers own close to $1 trillion. About half of the total commercial real estate debt is owned by banks, and 75% of that bank-owned commercial real estate debt is held by regionals. So I don't think we're out of the woods yet with what's happening, particularly with regionals that have concentrated exposure to retail and offices. Those would be the areas I'd be most concerned about. And the reason that it's important to look at commercial real estate is because this is where the first really big corporate debt maturity wall comes in. This is commercial real estate debt, of course, but it is still a form of commercial debt that is worth watching closely, because what it's telling us is that we're likely to have a bit of a bumpy ride over the next several years, as commercial real estate was largely financed by these regional banks. And at the same time, these same regional banks are not going to have the ability to lend out the same way that they had before over the next year or two, at the very least, if not over the next several years. So think about it. They're the ones who own a lot of this stuff. They don't have enough room on their balance sheet to take on more. So there's likely to be more defaults. We've seen some. San Francisco's seen a fair share, but cities around the country have seen some increasing rates of default in commercial real estate. So I think it's just important to watch. It could be a catalyst for what may happen with regional banking in the back half of this year. I've said that what happened in March was more of a liquidity-driven series of events, but we could see some solvency issues. This is something that my partner and I have talked about at Macrovisor as well, that the credit situation does create some risks, right? That this is something that we need to keep an eye on, because there are growing imbalances in the banking system because of this rate hiking cycle. There's still about half of the banks out there that have more liabilities than assets. And there's such a large mismatch because banks went so far out on the duration curve and so high up in risk in some cases that this shaking out could take some time. And the cumulative impacts of lagged and variable changes in credit availability and in the financial system as a whole due to monetary policy has not fully been realized. It's still only been about just over 15 months since the first rate hike, and it can take 12 to 18 months for all of those changes to really be realized by the market. And remember, we're still seeing the Fed do some measure of QT, and at the same time, they've hiked rates meaningfully, and we haven't even gotten a year out from when that meaningful hiking process happened. So the lagged impacts in the credit markets and the economy and so forth have yet to be fully felt. But what we do know is a lot of this commercial real estate debt is revolving, right? So as interest rates are rising due to Fed policy, the cost of this debt is increasing as well. So even before we get into the mass refinancing, there is still some sign of stress due to that rising burden. At the same time, in office buildings and in retail stores and in malls, there are rising amounts of delinquencies from tenants and even defaults from tenants that are putting increasing amounts of pressure on property owners. So you think about it, on both sides of the book, it's hard because you've got rates going up, so your cost of capital to maintain the property is rising, and then you've got your income going down. So if you don't have enough of a buffer, that can be a potential problem, something we're going to be keeping an eye on as we go through the year and into next year. And we can see this is a pretty fascinating series of statistics. The amount of vacant space led by San Francisco at 32.7% around the country is very high, in some cases the highest it's ever been, and others very close. The post-COVID normalization of office space utilization has not happened. And this is something that's a lingering concern for this space as we run into that maturity wall. Moving on here, AI-related stocks drove virtually all the S&P 500 related returns this year. If we take out AI stocks, we can see the S&P wouldn't really even be up. It'd be about flat on the year, and certainly well below 4,000. So it's interesting how powerful this narrative has been. Now, granted, I've said all along, I believe that AI has a lot of promise, and it will be basically one of the pillars of the fourth industrial revolution as we're able to harness its full capability. But I don't think we're anywhere close to that. I think that we've pulled forward a lot of returns. There's a lot of excitement here. We're sort of at the peak of the Gartner hype cycle, and there is room for AI to settle down, and we really need to see this as a show me story play out with a meaningful and near-term expansion of margins and productivity at companies in the quarters ahead. If we don't see that as early as Q2 earnings season, which is coming right up, then I don't think the AI story really has the sort of merit that's been priced in. That is to say, if we don't see companies that are showing us better earnings and better amounts of productivity from their workers because of AI directly, then we have to start to say that, we're not seeing the level of change we were told. Now, I can tell you that looking at some of these models, they have a lot of promise, but they're not there yet. ChatGPT is pretty cool, but it doesn't have the sort of capabilities that are going to be as disruptive as I think is being priced in a lot of these areas. So just my 2 cents on this. It doesn't mean that the AI stocks have to, come crashing down, but I think a little bit of re-rating of risk is likely to happen in some of these, particularly the ones that don't have a really compelling AI story to begin with. And looking at the Societe Generale AI indicator of news flow, we can see that mentions of AI in the news have surged this year. We've never seen anything quite like it. And this is one of the reasons it's on everyone's minds, because it's pervasive. It's everywhere. It's in the financial news. It's in the mainstream news. It's in tech news. It's in all these companies talking about it. Last earnings season, 110 S&P 500 companies mentioned AI to some degree on their conference calls. So it's all the rage. But the question is, does the reality meet the precedent that's being set by the hype? Are we going to see something where there's this renaissance in how companies do business and how we access information and how productive we are at work? And I've yet to see it. In fact, productivity has been going down. And we've had a lot of models resembling the current AI technology that we're experiencing in the public now for quite some time. Now, granted, some of them work really well and some of them do increase productivity, and some of those productivity gains have already been realized. And also, granted, when some of this technology allows us to really merge all of the disparate sources of information, the different silos that are out there in large enterprise space as a part of digital transformation, that's going to be meaningful. And there's companies out there that are working on those types of changes. Companies like Palantir actually do have technology that's pretty promising in that space and could be considered early stage AI or very advanced machine learning and data analytics. But we need to see, the CapEx. Companies need to spend a lot of money to make this happen. So we should see that first. And then if it works from the companies that did it and it actually played out as expected, then we should see the expansion in earnings, right? So we have yet to see. This is a show me story. I'd like to see some level of improvement in Q2 earnings. Remember, this stuff is not very new. It's just being talked about a lot more lately. And yes, we're making some progress, but I think we're getting a little excited with tech as a whole kind of trading at around 30 PE plus for companies that are large and profitable. And for the ones that are trading just on price sales with no profitability, we're seeing these things in the high double digits again. And again, that's borrowing ahead. Even NVIDIA is at about 140, 150 PE with trading at 40 times sales. It's a great company. They have amazing technology, but it's a little frothy here. So just things to consider as we navigate the second half of this year, because as we get into next week, after it's over, the first half is over, and now we have to start considering what it's going to look like during a time of year, particularly between July and October, where it can be a little more choppy in the markets. When we're looking at TLT versus QQQ, we can see there's still a rather large divergence here. Has the correlation broken? It remains to be seen. I don't think it has, because we're seeing other things that add to this picture. And that is that the multiple expansion of the NASDAQ has been significant. This move hasn't been supported by earnings. It's been more by about 7 to 15 very large stocks that have caught most of the bid this year. That concentration has led the NASDAQ to outperform the S&P, the Russell, the Dow significantly, but it's also led to significant multiple expansion. So the valuations now are pricing these things into perfection, but their growth is not so great. In fact, Microsoft's the only tech that's really showing decent growth. The rest are lagging quite a bit. So my concern with what we're seeing in this chart is it's just we're not pricing in risk. It doesn't mean the markets have to go lower from here. It doesn't mean that everything is gloom and doom. And I love how people get all upset when I post charts like this out there on social media. And obviously there's a lot of people that like these charts because they get a lot of engagement, but some folks get a little upset and they say, you're just hoping for this scenario, or this chart doesn't work anymore, or this has no relationship. I just like to say to those critics and everyone else that this is just a very simple chart of looking at risk premium. And risk premium is at the lowest level in 22 years. So you're getting better money going into fixed income with lower risk than you are getting compensated for in equities. With where things are going with earnings yields right now, and particularly with earnings in a earnings recession, we've seen 2 sequential earnings of S&P earnings in the negative, NASDAQ earnings in the negative, right? That's an earnings recession. We're likely to see another with Q2 earnings at the index level. And so it already tells us that this multiple expansion is a little bit out of control. There's been liquidity factors. There's been the AI narrative. And in fact, if you look at this chart and you look at the AI chart I showed a couple charts ago, you can see they're almost the same thing. Why? Because the broader market is basically flat, just like TLT. And there's this very concentrated component of mega cap stocks that's been outperforming. It's up about 60% year to date. Right, where the rest of the market, S&P is up, about 15%, and then the S&P 493 are up something like 4%, maybe 3.5%. That's the other 493 stocks that aren't really performing as well this year, and that's most of the market. So when people say, what a bullish market, what a great market, if you're in the right places, it's been very rewarding. But if you're like a lot of investors and you either have single stock holdings or index exposure in the S&P, it hasn't been quite as rewarding. And we can see this going back. A lot of folks ask me for a longer term chart. I'm just going to bring this out and say, going back in time, all the way to 2018 to the present. So we've got a sample period of, a number of years here. This is a good almost 6-year sample period. And we can see that the 10-year real yields inverted, which have had a very strong positive correlation with the performance of the S&P 500 Infotech Index, that there's this huge divergence. It's absolutely breathtaking, and it has everything to do with the market is ignoring these higher real yields. This is very unusual. It's not just a one-year phenomenon, it's a multi-year correlation. And it typically ends up that the market catches down to these real yields in terms of this inverted chart. Now, it doesn't mean, again, it doesn't have to happen. These are different comparisons, and the reason that I bring them out is to show you as an observer, as a student of the markets just like me, what has happened in the past and what we could be at risk of. I've been accused on social media of being a purveyor of bearish narratives. The only reason that I tend to lean in that direction is because the data, the preponderance of information that's available from all different objective sources leans in that same direction as well. Now, over the longer term, I think markets tend to go from the bottom left to the upper right of the chart. They tend to go higher and higher over long enough periods of time. But we're now in a period of time where the types of gains we've experienced in such a short period of time, the first half of this year setting up to be the best first half of the year ever for tech. Maybe, just maybe, it's a decent time to consider raising some cash, looking at some of the risks out there. And for folks that are content to stay invested, maybe looking at hedges. They've People wiser than me have said, hedge when it's cheap, not when you need to do so. I think that's a pretty wise bit of philosophy. And it's certainly something I would be more inclined to do if I was very long tech in here. But at the end of the day, the tail risk is leaning decidedly left and growing fatter because of the concentration of positioning, because of the types of moves we've seen in this market. If you are a TraderAid member, check out the Navigating the Markets article I just posted. There's so much depth about all this, about the sentiment, the flows, the positioning, what's going on in the options market, and everything else that I see and some of the risks that are building. You can get a very, very deep view. And you can sign up to TraderAid with a 7-day free trial, and you can use Mayhem 20 to get 20% off your first month or year on me. So if you like the trial and you go forward with staying on as a member, awesome. You'll get that 20% discount on me. But highly recommend checking out this week's Navigating the Markets, because if you're interested in what's going on and the sort of extremes that I have my eye on, I go very far in depth on what all is happening in that article. And here's an interesting chart that tends to get people's attention. This is the S&P 500 in orange versus Fed net liquidity in purple. So that's the balance sheet of the Fed. And then we're subtracting away from it the Treasury General Account plus reverse repos. And so what this is showing is essentially that liquidity has been on the rise. It has been helping to support the market, but we're probably likely to see this fade a bit. Summer comes to mind as one element of liquidity starting to be drawn out of the market, but the other is that the Treasury General Account is being more filled by bank reserves and deposits coming out, so it has the same kind of cumulative effect to chase some of these treasuries than the reverse repo market. And the reverse repo market saw a noteworthy drawdown, largely from what appears to be tax payments from corporations and others with estimated taxes more than money flowing out of it to chase some of these treasury bill issuances. And we have another big week coming up. So it'll be important to take a look at how those impacts may have an effect on the market and realize there are lags to these impacts. It can take weeks for them to really be realized. The NASDAQ's recent rise in valuations is the third sharpest in the past 2 decades, exceeded only by the post-Great Financial Crisis and COVID rebounds. Now, you could read this 2 ways. You could say, well, this means that we're back in business, the bull market's here, and now we need to grow into these valuations. Or you could read this as, wow, what a prolific bear market rally. Now they have these very, very stretched valuations to grow into, but we didn't see the great de-risking going into this. We didn't see them discounted significantly going into this, right? So now PEs are historically elevated in the NASDAQ, and we've seen this great expansion in multiples that's pulling forward returns. Now these companies have to grow into it at a time where their earnings are slowing or even in negative territory. So something to keep an eye on. Someone's wrong here. It's either the market that's pricing in the NASDAQ or it's the estimates of earnings moving forward, right? Either the market is getting ahead of itself or estimates are too negative. One way or the other, we'll start hearing more with Q2 earnings season. And options remain the market at over 40% of daily traded volume. This is a chart from Goldman Sachs. It shows SPX total volume, and these are options that are expiring in 6.5 hours or less. So we can safely say that 0DTE is still a big, big chunk of this market. And the squeeze sentiment, this chart from JP Morgan Chase shows that we are at the same level of squeezy sentiment that we saw in January of this year, as well as what we saw in Feb of 2021 and parts of 2020 when we had these epic squeezes. Now, why is this important? Because some of the short squeeze stocks are some of the biggest rallying components in June, and I think that's a bit of a warning sign that this rally is getting a little bit stretched when everyone is juicing these squeeze stocks. That tends to be a sign of exhaustion. There's plenty more on that in that Navigating the Markets report. The Magnificent 7 bubble from the S&P 500's biggest 7 components, accounting for 28.2% of the index. This is pretty significant. It's something that I think illustrates just how much concentration there is. And I would say it's a bit deleterious to have so few stocks. There's an index of 507 make up almost a third. That's just not how this should be. It certainly makes me want to look at being long equal weighted and short market cap weighted S&P until this starts to resolve to a more normalized level. I think the mega caps are extremely expensive here, and I don't think it's sustainable. And even in a downward market or a sideways market, I think equal weight can outperform from here given the surge we've seen. And there's just no reason to buy stocks according to this chart from FT, which is showing that this is the first time ever where this risk premium now has inverted, where you're actually going to be rewarded more for taking risk in corporate investment bonds or 3-month treasuries versus the earnings yield of the S&P 500. So what does this mean to the average everyday investor or trader? Fixed income, treasury bills look a lot more attractive. Corporate debt, investment grade, even looks more attractive than owning stocks here based on where earnings are likely to go. And this 12-month forward projection could even be a little optimistic in the S&P, which may mean that fixed income is even more attractive. Leading indicators are pointing to a recession. This is the leading index from the conference board. This is from a macro bond chart. We see them continuing to roll over 14 months in a row of negative leading economic indicators. We've seen this happen before, and since 1960, anytime there's been 6 or more months of negative leading economic indicators, we've seen a recession follow. What's the delay, you might ask? We need to see if a recession is going to happen, the services sector go into contraction. We haven't yet. We've seen it in a mild expansion from the last final ISM services PMI that we saw at 50.3, and that was showing some signs of slowing internally, including with new orders and backlog. If we see a continuation of that theme, then we may see some signs that the economy is slowing further with more firings, more jobless claims, right? And so my theory here, and what we've been talking about at Macrovisor a lot, is that the services sector being such a key part, really 3/4 of the economy, until it goes into a multi-month expansion, 3 months or more, it's unlikely the labor market's going to meaningfully break. And by break, we're looking at jobless claims of 300,000 or more per week for a sustained period. So if we do see the services industry begin to break, which I think is likely from Q3 moving forward of this year, after the revenge spend travel season winds down and all that travel and leisure and other temporary hiring starts to go the other way, I think that could lead us towards the moment where the economy really does begin to slow and we could see some negative growth. So it's going to be important to watch as this plays out. I believe that the theme that we've discussed at Macrovisor is the recession has been delayed, but it hasn't been canceled. And we can see that the changes in loans outstanding is something that we're seeing some expansion in, but not nearly where we were before the jitters in the banking system really began to pick up early this year, something that we saw the Fed remark about, something that then later led to the implosion at Silicon Valley Bank, and something we warned about at Macrovisor on February 2nd in an article talking about what was going on in the banking system and the economy as a whole that was beginning to concern us. But what we can see from this latest reading that is noteworthy is commercial and industrial loans are actually going negative. We do see credit tightening pretty significantly, and it's likely that we see this continue on. Another thing you can take note of is the dark blue commercial real estate. The appetite for that type of debt, the changes in loans outstanding there, that has diminished significantly from the prior period. And we can see that's pretty noteworthy change from what we had seen earlier this year and late last year. So maybe call it normalization, maybe call it something else. Let's see where this data takes us. But the problems in commercial real estate, the problems in overall credit conditions tightening, and the impact that has on a debt-driven economy are still in their early stages of manifesting and being realized. And service sector employment drives growth in the US. This is exactly what I was just talking about a little bit earlier. So on the other side of it, we need to see if there is to be a decline in the services industry and in the broader economy, this change, right? And I think it will. We can see education, healthcare, business services, government, leisure, construction, warehousing. Those are all the key areas where there's been growth in the 1 month change during May's non-farm payroll. Let's see what June's data brings us. But this is still very interesting because it has been so resilient during an otherwise pretty challenging economic period. And so unless the services industry really begins to wind down a bit, the other challenge is inflation won't. The stickiness of inflation on the services side could remain a bit of a challenge. So I think the Fed is really looking to try to put some additional pressure on the services industry in order to try to diminish some of the cost push inflation that we're seeing from services where prices paid have passed through to customers' costs paid. Now we're seeing some measured decline in that, particularly in manufacturing, but some signs in the services industry that maybe that pass through is diminishing, but not enough to give the Fed comfort, particularly with core PCE expected to come in around 4.7% for the month of May, the reading we'll get in the week to come. Labor demand remains on a cooling trend. This is an interesting chart as well. It just shows us that we're seeing some softening, but look at how elevated JOLTS are, or job openings, the component of that survey, versus where we were pre-COVID. So we still have about 1.5, 1.4 jobs available for every unemployed insured person seeking work. And until that number drops meaningfully, it's not likely that we see the kind of slack in the labor market that could help to drive down inflation. So again, a lot of these jobs on offer are for the services industry, and so that's why that area of the economy remains key to watch closely. And we're looking at this composite of both ISM services and manufacturing. And we can see that manufacturing, if we're looking at the ISM data, is actually pretty deeply in the red. I think the last reading was around 46. So services is what's holding this up and keeping it in marginal expansion. And that's the other reason that we need to see, because you can see the correlation between NFP and composite ISM. If services doesn't roll over, neither does employment, right? So everyone's sort of on the same page in economics that if you want to see inflation come down, unfortunately, you need to see aggregate employment come down. And if you want to see that come down, then services needs to see some pressure. And for that to happen, the Fed needs to stay on course. So we'll be watching and waiting. But so far, no material progress in the overall tightness of the labor market. It's very, very, very limited. And Taiwan's export orders plunged. This is a country that exports a lot of semiconductors, machinery, and their export orders continuing to plunge. 9 straight months of declines mirrors what we've seen in our own ISM manufacturing data. 9 straight months of declines with 13 months of falling new orders. This is something that is a globally synchronized reduction in the appetite for goods. China's reopening really hasn't had the impact of bringing this back, and the stimulus that we've seen in various bills like the Chips and Science Act and the Inflation Reduction Act haven't really had the impact of offsetting this. In essence, the pull forward of demand we saw in goods, you could see in this chart, post-COVID stimulus, that created a lot of effects where people and companies and governments were buying things they wanted to get 1, 2, 3 years in the future with money today. And so now that we're in that period where we're after that surge in demand, there's much less. Plus, debts become harder to come by. You know, if you're looking to get credit, it's harder, it's more expensive if you can get it. So it's less likely that you're pulling forward future demand by employing leverage as well. And that's all slowing an economy that is driven by debt. We can also see China's reopening is slowing pretty meaningfully. And all of these numbers here, whether it's industrial production, retail sales, fixed asset investment, they're lower than what economists were hoping to see. So there's still an overhang in Chinese construction and real estate. It remains a problem. There's still some subdued consumer activity post-reopening. We can also see consumers aren't particularly interested in getting into additional debt. So the kinds of things that you would typically see early in a credit cycle are not really happening. Maybe it will happen later. Maybe it will be necessary for there to be more stimulus or more programs for the government to boost confidence. But at the end of the day, the China reopening is not the global catalyst or the decoupling moment for East versus West that some had thought it may be. And that begs the question, will China's domestic consumption keep on driving the economy? We can see retail foot traffic is dropping off pretty materially if we look at retail parking activity. This is a neat little survey done by a company called SpaceKnow that's actually using geospatial imagery to determine whether or not there's more shopping going on. So while the China data lags us, the retail trade data, this foot traffic actually suggests that retail activity in China is about to drop off pretty markedly. And the UK debt is now greater than the size of the country's economy. This is the first time we've seen that happen since the 1950s. And really, it happened initially, the first time on this chart, because of World War I. This time, it's more because of trying to fight a pandemic, but also dealing with an unsustainable budget system. And unfortunately, that's pushed UK into not only a situation of exorbitant amounts of debt, although who are we to speak over here in America, but also with a rather sticky inflation problem, one that's among the worst in developed countries right now. In America, we just crossed $32 trillion. So congratulations to everyone here. We now have more debt than the combined GDPs of China, Japan, Germany, and the UK. And that means there's about $250,000 of debt per household, or close to $100,000 of debt for every person, including every newborn child in America. And the stock indices recover from the Fed rate hiking campaign, almost as if it never happened, particularly in the NASDAQ. I think that's rather intriguing, and it pretty much tells the Fed the market does not believe them at all. And ETFs hit a record amount of assets allocated into them, over $10 trillion globally. This is pretty massive. The shift between active and passive has been $2.53 trillion coming out of active and going into these ETFs. And that's helped to propel this concentration in some of the largest stocks. Now, active managers have been mirroring some of these index weightings as well, so they're no exception to the rule. But typically, you see at least a little more potential for varying strategies and diversification in active strategies versus passive index funds. So this passive flow has been one of the reasons that we've seen such a large concentration in some of the biggest stocks out there, getting even bigger. And Japanese equities have been strongly in favor. We've seen that since the sell-off last week, that there was a meteoric rise in the Nikkei. One of the trades that we had on at TraderAid until recently was long Nikkei, yen hedged, short China. And it actually worked really well. Took it off because we started to see positioning get a little extreme in both situations. Shorting in Hong Kong was getting very lopsided, and long futures positioning in the Nikkei 225 was getting very lopsided long side. So we looked at taking off that trade, but it was a very good trade in a short amount of time. I think it yielded about 15 to 18%. Depending on your entry point. And we can see that the positioning and the flows in Japan are getting a bit stretched. So for me, I think it's a good time to take profits there, even if one was just long. But that's just my 2 cents. We can also see Japanese semiconductors extremely on fire. I mean, just absolutely surging this year. Never seen anything quite like that. And it's very interesting because their semiconductors are actually not doing too well. The exports there are sideways to down for the most part. So price diverging from reality or catching up, we'll have to see. Money market fund assets are also near an all-time high. We have seen some outflows from there recently, but the rising rates from the Fed hiking cycle have certainly pushed a lot of money into these more liquid funds that are yielding attractive rates. Cash, certainly not trash in this environment. And the magnitude of historical inversions preceding recessions, the one we're looking at here, is astounding. 49%. Right? This is the most on the chart, and it matters. And folks, the gentleman who invented this study has said that we're probably in the eye of the storm right now before a greater recession comes. And he's not some kind of perma bear. He's a pretty objective economist, but he's pretty concerned about what we're seeing. Field conditions for wheat production in Kansas are at the worst level since 2010. This is one of the themes that we're going to be talking about a little bit at Macrovisor, this theme from abundance to scarcity and how it impacts a number of different areas, including agriculture, drought being one of the drivers. And it's only getting a bit worse over time. And bear markets, we've had 2 situations where we had such a meaningful break above the 200-day moving average where it ended up being a head fake. That was 1982 and 2002. We'll have to see whether or not this time proves to be real or not. If it does, it's going to be the most expensive new bull market in history, and formed without a lot of the things that typically happen before a new bull market, like a massive de-risking. Right now, households have almost a record amount of their net worth in equities. The record was set in 2021. We haven't seen that de-risking. We haven't seen the Fed turn about on policy. They've only potentially paused, but they probably have one or two more hikes, given our view at MacroVisor. That's what we're looking for this year. And we haven't seen a recession, not a real one. We've seen sort of a very shallow 2-quarter sequential dip in economic growth last year. But typically, we see also an earnings recession that troughs before there's a bottom in equities. And usually it's on average, looking back 100 years of monetary policy, about 10 months since the first cut that you see a bottom in markets, right? So it comes 10 months after because the Fed's cutting into something unpleasant that's happening. We haven't seen any of those things. So that doesn't mean it's not a new bull, but if it is, I imagine it's going to be rather short and rather sweet because it's unlikely companies can grow into these stretch valuations during an earnings recession and during a time where economic activity is becoming more constrained. So I want to thank everyone for tuning in. I really appreciate it. Your support of my work is exactly what makes it all possible. If you like the longer term picture, the top-down macroeconomic analysis, and the deeper dives in that subject, check out MacroVisor. It's a project that we started earlier this year, and we're putting out a lot of great content. There's a lot of very interesting themes that we're putting out as well for longer term trades and investments that are focusing on that top-down analysis. If you're a short to intermediate term trader and you're driven more by technicals, check us out at TraderAid.com. where we focus on helping traders cut through the noise, find their signal, and sharpen their edge. You can get 20% off TraderAid using the code Mayhem20. That's for your first month or year. And there's also a 20% discount you can find in the description for MacroVisor off your first year. If you take advantage of that, either way, you're helping to support my work, so there's more content like this that can come out. And you also get access to exclusive, in-depth content from MacroVisor and great trading education and ideas from TraderAid, depending on which you support, or you can always decide to support both. And follow me on Twitter at Mayhem for Markets. That's Mayhem number 4 Markets. And again, be sure to like, subscribe, and share this video with your friends and your contacts on social media. The more that it gets out there, the more that I can help other people and hopefully open their eyes to what all is going on out there in the world. And as always, I appreciate your support. Thanks again, and I'll see you soon.